Imagine waking up to a currency pair that just moved 80 pips overnight and realizing you missed it because you didn't factor in interest rates. Yeah, that stings. But what if I told you that understanding interest rates could be your secret weapon in the Forex game? Welcome back to FX Limit, where today we're diving into the top 5 tips for trading Forex based on interest rates. First, let's talk about the core principle interest rate differentials. When you're trading Forex, you're not just trading a currency. You're trading the relative strength of two economies, and interest rates play a central role in that. If one country has a higher interest rate than another, investors will often flock to that currency to earn higher returns. That creates demand, and demand pushes the price up. So, tip number 1, always check the interest rate policies of the central banks tied to your currency pair. Tools like the Economic Calendar on Forex Factory or Investing.com make this super easy. Tip number 2, follow central bank statements like a hawk. These guys don't just raise or cut rates on a whim. They usually signal their intentions in advance through speeches, meeting minutes, or economic forecasts. If the Federal Reserve hints at tightening while the European Central Bank sounds dovish, you better believe EU or USD will feel the impact. Having a reliable trend-following tool like the Apex Trend Indicator by FX Limit can help here. It won't interpret central bank language for you, but it can show you whether the market is already reacting blue for bullish trends, red for bearish. That visual cue can be gold when volatility hits. Tip number 3 is a game changer. Understand carry trades. This is where traders borrow money in a currency with a low interest rate and invest it in a currency with a higher one. For example, borrowing in JPY and buying AUD. If you're holding trades overnight, the interest rate differential becomes your daily payout or cost. Knowing which currencies are likely to be the funding currency versus the investment currency can add a whole new layer of profitability to your strategy. Tip number 4. Timing is everything. Interest rate decisions usually cause big moves, but the reaction isn't always straightforward. Sometimes a rate hike is already priced in, and the currency actually drops when it happens. That's where confirmation tools come in. If the Apex Trend Indicator confirms your direction with a new signal and success rate of over 70%, you're not just guessing, you're aligning your trade with actual market momentum. It's one thing to bet on a central bank, but it's another to see the market actually moving in your favor before pulling the trigger. And finally, tip 5, don't ignore the global picture. A rate hike in Canada might not mean much if oil prices are crashing. Interest rates are important, but they don't exist in a vacuum. Combine them with technical analysis, market sentiment, and trend confirmation. That's what pros do. And if you want help filtering through the noise, the Apex Trend Indicator's non-repainting signals and built-in dashboard can do a lot of the heavy lifting. With alerts sent straight to your phone or MetaTrader platform, you'll know exactly when a trend shift aligns with macro news. Interest rates are powerful, no doubt, but it's your ability to interpret and act on them that defines your success in Forex. So keep learning, keep watching the banks, and make sure you've got the right tools on your side. If you're ready to stop guessing and start trading with confidence, check out the Apex Trend Indicator at axlimit.com. Until next time, trade smart and stay ahead of the curve.